Welcome back to another episode of the Groundwork. I'm your host, Harris Evans. Ever gone to invest your money, made it all the way up to the account opening page, and only to feel overwhelmed by all the different types of account options? If this sounds familiar, you're not alone. And you're in the right place, because today, we're getting back to the basics. We're going to walk through some categories of different types of accounts that you can use to save and invest. We're going to talk about how each one of them is taxed, how they're typically used in a financial plan. And keep this in mind. This is a high-level overview, but it's one of the most important building blocks in understanding how your money works for you. I like to group these types of accounts into three main categories. Let's take a look at them. Let's start with taxable accounts. These are the most flexible accounts that you can own. There are no limits on how much you can contribute, what you can invest in, when you can access the money, or what you want to use the money for. These are often referred to as brokerage accounts in the investing world, but you could also consider your savings account and CDs at the bank under this same category. You've already paid taxes on the money you've contributed, so you'll never pay taxes on that portion again. You will only pay taxes on the growth and the interest when realized. And even that can often be managed or minimized depending on how the account is invested. These accounts are commonly used for flexibility, goals before retirement, and ongoing tax planning. Let's talk tax later accounts. For these accounts, you're able to contribute money before it's taxed. Your investments grow tax deferred, meaning you don't pay taxes as the money grows in your account. But then when you take the money out or access it, it's taxed as ordinary income. These type of accounts include your traditional IRAs, 401ks, 403bs, 457 plans, essentially any pre-tax retirement account. And unlike your taxable accounts from before, there are a few things to keep in mind. And while there are exceptions to every rule, if you access these funds prior to age 59 and a half, penalties may apply. Got other income sources in retirement and don't need the funds? Well, at a certain age, the tax man is going to want his tax bill he's long waited for. The IRS is going to mandate you to withdraw from the account. This is called your required minimum distribution. Think of these types of accounts as a tax bill later arrangement. Get the tax deduction today, and when you owe taxes in retirement, ideally at a lower rate. It's not always the case. Last and certainly not least, we have our after-tax accounts. These are funded with after-tax dollars, and you pay the taxes up front. But from there, the growth is tax-free. Withdrawals are tax-free, and in most cases, this money is never taxed again. These include your Roth IRAs, your Roth 401ks, and even college savings accounts like 529 plans. Now, there are rules around accessing, like timing with Roth accounts before age 59 and a half. And with the 529, there obviously are some restrictions around the purpose of the access of the account. But the long-term tax benefits can be significant. Now, there is one account in this category that I have not mentioned that could be considered a triple threat when it comes to tax benefits, because you can add to it pre-tax, it can grow tax deferred, and used at the right time for the right purpose, it can be accessed tax-free. It's called a health savings account. This thing is so important, we're going to dedicate a whole video on it later this year, so you're not going to want to miss that. But this category is used for tax-free growth and to create a tax-free account that is accessible for spending sometime in the future. So which type of account should you have? Short answer, all three. Long answer, it depends. Depends on your age, your income, tax bracket, what you want your money to do for you, and whether you need flexibility today, tax relief in the future. Robust financial plan often includes a balance of all three. Now, that balance gives you more control, not just over your investments, but over your taxes, both now and in retirement. Because remember, it's not how much you have in your account, it's how much you get to keep. And if you're wondering which accounts make the most sense for you and your family specifically, today and decades from now, I'd be glad to help bring clarity to those decisions. Now, we're going to be going into depth on some of these accounts I mentioned above later this year. So this is a good foundation for what is ahead. Speaking of what's ahead, February. Can you believe it? It's already here. And it's love month, baby. So we're sticking with that theme. And walking through practical ways your money can reflect the values of love. Because as we know, love always protects, love always endures, love always hopes, and love always trusts. I'm excited about it. I'll see you then.